So let's get back to for a second when I did the ChairInc presentation for you, which is very similar to the MaxInc. And my intention of doing ChairInc was so you can see what the steps are, was that you would look at this and then create an Excel file of your own, obviously not cut and paste was for 20 years, but just for these, to have the size of the font be a little bit larger. I'm not showing it over here, as you recall. But we went through, all the way from sales to cost of goods sold, gross margin, and so on, and eventually we came up with the net income. And now that we have the net income, we said we are going to do, which is what you are doing for Part C, is to make the connection between net income and figure out what the cash flow is. Cash flow, so we are adding back depreciation. If we made any investment, in that case for 100,000, and we need some change in working capital, we need so much. We did the net cash flow, and then from there I said if the discount rate R was 15%, your NPV would be 176,000 and IRR would be 22%. At that point I did not spend time discussing what does an NPV or IRR mean. But now that you have to do Part C, it is time to discuss those concepts. Okay, so starting with the generic comments about investment analysis methodology. As I said, there are various methods that are used, and there are basically fall in two types. One is where you are looking to ask the question, how long does it take? How long before the investments we are making is recovered? Okay, and that would be the amount of time it takes to pay back. So we're really talking about time, how long, would be in years or in months. And the second type of payback is very similar to payback, but it's called discounted payback. Okay, this is where the concept that you have read in the book of discounted cash flow is going to come in play. So I will talk about how do you do discounted cash flow. And once we understand the discounted cash flow, that will make it very easy for us to talk about the net present value and also the IRR. Okay, so in this presentation I will explain it to you what they are, and with some simple numbers we will do some calculation, and then this way you can practice on your own and also apply to the MaxInc analysis. Okay, so what is a payback? Payback is as I mentioned, is going to be time. So we have time. So we have time. Time here, and question really is how long does it take for us to get the money back? And so that's one of the methodologies. And so what and how will one do it? So let's talk about it. Okay, so again, kind of reminding ourselves that when you are applying these analysis, you have basically done the cash flow analysis. If you're investing in a business, we do the analysis, we do the income statement, we do the working capital, investments in cash flow, and a few other things that we have to go through. And let's say for that project, and again, just to keep the numbers simple and not focus on the numbers, but focus more on the methodology. Let's say we came through and this is what our cash flow comes out from that project. Typically in an investment analysis, when we do the first year where we're making the investments, typically called year 0, year 1, year 2, year 3. Okay, and let's say when we did the analysis, year 1 we turned out to be a negative 100,000 cash flow, and the next year we made 10,000 positive cash flow, and the year after we made 60,000 cash flow, and then we made 80,000 cash flow. And let's say the life of the project is, in this case, 3 years. So this project will end in 3 years in this example. Okay, so that's the set of cash flow that we have accomplished for this make-believe project. And what I want to do is to use these numbers. What I want to do is to use these numbers over these years and be able to walk you through, these methodologies. Okay, so first one I want to talk about is a payback. Okay, so payback is going to be how long does it take for us to pay back. So here was a project. Remember we said from the last chart, year 0 we have negative 100,000, then year 1 we are positive 10. Because as you're typically in a business, you're going to start to make money as a in the latter years. And here we got. Now again, this is a cash flow, and we get to the cash flow after doing all the net income and everything else. So the payback basically means is to say how long does it take before I am going to recover the investment I have made. Now typically, sometimes as a metaphor, I would basically say is that one of the ways to think about payback is, let's say, we dig a hole, and let's say this is the hole in the ground, okay, and so we basically have invested $100,000 for the project. Now the question is, how long does it take for this hole to get full, okay? And that's how you want to think about the payback. So now, first year we make 10. So if I take this 10 and I put it in the hole, I will cover some of it, okay? Next year we make 60. If I put that in, I will cover more of it, okay? I'm still not covered. Why? Because I can see that as I am taking my 100, adding 10, I'm left with still minus 90. Adding 60, I'm still left with minus 30. And when I look at the third year, what we make 80, when I look at what happens for that, which means taking minus 30 and adding 80, we end up with 50. So what this says is that up to second year, where I have positive 10, positive 60, which is 70, putting it against minus 100 is obviously still 30. So I still have that much hole to be filled, okay? So what we need is 30,000 from next year's 80,000. We need 30,000 from next year's 80,000. And so the payback period, how long does it take, will be obviously 2 full years, because by this time we're still negative, which is minus 30. By the end of third year we are positive, which is plus 50. So the answer is somewhere between 2 and 3. So the calculation will be, obviously I have 2 years, and then I need 30 from 80, or 30 divided by 80, and we get this answer, 2.375. So that is what a payback means. Payback means how long does it take for us to recover. How do we do that? We basically can imagine how I'm filling the hole, and mathematically what you do is you keep adding the numbers till you get to the positive, and this between this year and this year is the answer, and the question is how much. I need 30 from 80, and that's how we do it, okay? So that's the payback. Now, next thing I want to introduce is a discounted payback, where we have to calculate a discounted cash flow. And I'm sure as you're reading the book, you may have comprehended discounted cash flow, and maybe you have some questions. So at least from that perspective, I want to try to cover those concepts for you, okay? So now we're going to get into talking about it. What about the discounted cash flow? So the discounted cash flow, is, we have to do it in 2 steps. First, we have to figure out the discounted value for each year. And that's what you are going to now learn. What do they mean? What do they mean when they talk about in the book, when they're covering, things like DCF, and they're talking about time value of money, and those things you start to get a feel for it, okay? So let's talk about discounted cash flow. Now, the concept of time value of money is that there is a present and there is a future, okay? Now future could be, this is a future, obviously, this is 1 year away, this is a future, this is 2 years away, and this is a future, it is 3 years away, okay? So we have present, which is typically called present value. We have a future, which is called the future value. And the relationship between present value and the future has got 2 things. One is N, which is the time. And the second one is R, which means that if we are going to put the money here, and if you're going to grow it at R of, in this case, 10%, how much will it be in the future? Okay. Now, the inverse of that is if we have money that we are expecting it in the future, and if we want a 10% return for a project, if we want a 10% return for the project, the question is how much will this be worth in present? So the formula, as we saw in the book, is that if I want to know a future value, I would take my present value and I will multiply this by 1 plus R, which is the rate, and I will raise it to the number of years it is out. If I want to know the present value, we take present value and the formula will be whatever the future value cash flow is, and I would divide it by 1 plus R raised to n. Now some of the stuff may seem a little confusing, but I go through the examples, I'll guarantee it will become very clear for you. So let me just kind of wrap up at least conceptually what this means before I go to the next chart. So time value of money, you have present value, you have future value, you have n, which is the time, and you have the R, which is the growth that is taking place between the times. If I want to know future value, if I want to know the future value, I start with the present value and multiply this by 1 plus R. R is the rate and how far it is. If I want to do the opposite, if I have money in the future, if I want to know the present value is, the formula would be whatever the cash flow is in the future divided by 1 plus R raised to n. Okay. So now we're going to do is we're going to apply this to the basic cash flow that we just came up with a couple of charts ago. What I said is minus 10, 10, 60, and 80. Okay. So let's talk about that. So here is, let's first do the calculation for this situation, so you can understand from a logic perspective what does this mean. So what this means is we have $100. Again, remember I said the formula here is what? The formula here is present value is future value over 1 plus R raised to n, and n in this case is 3 years. So this would be 100 divided by 1 plus R, which is 10%, okay, and 10% basically means 0.1, percent is 1/100th of it, 0.1. So if I add R to this, 1 plus 0.1 will 0.1 will be 1.1, and I will raise to 3, okay. And if I do the calculation, I will get a number. And again, I'll show you how to do it in Excel, when I open the Excel file up. But that's what they are talking about, discounting cash flow. That means I'm discounting this number to the present value. And how will I do that? I would take that number, I would divide it by 1 plus the rate, and I would account for the time, and that's how you do it, okay? So what will the number look like in this case? It will look like, if you do the calculation, on your calculator or in Excel, you would get, again, this formula, I guess this R is missing in here. And so that would be 100 divided by 1.1 raised to 3, and this is the number you would get. So the DCF, the discounted cash flow, the DCF of this number is that. How do we do it? We divided that by 1 plus R and raised to the n for that year. Now, so what if we had numbers here and here and here, and that's what we have a project like we mentioned. And so same thing with the Max Inc. So now, if I look at the discounting process, and then we talk about the discount payback, if I look at the discounting process, here was the cash flow. Remember we said year 1 we had minus 100, then we had a 10, and we had a 60, and we had an 80. If I want to do DCF, discounted cash flow, of these numbers, I would take each one of them, and I would divide it by 1 plus R raised to n, 1 plus R raised to n, 1 plus R raised to n, 1 plus R raised to n. Okay, so for example, this one, just to have some more space over here, would be 100 divided by, R is 10%, so it would be 1.1 raised to 0 because it is year 0. This one over here will be 10, but that's the cash flow that year, divided by 1 plus R, again is 1.1, raised to n in this case is 1. This one would be 60 divided by 1 plus 1, 1.1 raised to R, in this case is 2, and so on and so forth. If you do the math, the discounted cash flow for year 1 will stay the same. Because it is year 0, there is no discounting taking place. This is the number you will get when you discount 10 to the present value, for 1 year. This is what you're going to get, 49.59, if you discount the 60 for 2 years. This is what you're going to get if you discount 80 for 3 years. That's the number you'll get. So this is your DCF. Okay. So when they talk about DCF in the book, that's what they're talking about, discounting the cash flow. Now, applying that to the payback, for the payback, basically, what you're doing is now you do the same logic we did before when we did the payback. Remember, I gave you the example of, we dug a hole and which was about 100, 100. So we got 100 deep, and then we take and we have positive 9.09, so we fill it in, so we fill a little bit of it. Then I got a 49.59, so I fill a little bit more. Then I know between here and here, this is a positive. So between year 2, this is year 2, and year 3, this will become turned positive. So we need 41.32. We need 41.32 from 80 that is going to be created next year. So that will tell us what fraction of next year we will need. So the answer will be 2 plus 41.32 divided by 60, which is 0.7. So the payback is 2.7 years. Okay. So what is the learning over here? Important learning for you is the discounted cash flow. How do you do it? And so that will, that's what's also going to be used in the NPV. So I will post some practice problems for you. I will give you the numbers. I will even give you the answers, and you can go and do it on Excel so you start to get comfortable with it. Okay. Let's talk about net present value now. Okay, NPV. NPV. So let's talk about NPV. What does it mean, and how will we calculate it? Okay. NPV is, as it says, it is net. N is net present value. So remember, this is what they're talking about. They say, hey, take the present value and net it, which basically means you are adding up all the net present values, adding all present values, which is, present value again is your discounted cash flow. We just did that, okay? And we'll do it again so you can see what it means for the NPV. But that's all it is, okay? So I will do 2 examples for NPV, so at least you can see, twice, and then we will do IRR, and after that I am going to go on to Excel. Okay. So let's take an example. Let's say that this is another project, not the one we talked about before. Like I said, I want to do at least a couple of them for you. So in this case, let's say this particular project, again, they want to make a return of 10%. So R is, R in this case is also 10%. This project goes over 4 years. In year 0, there is no cash flow. Year 1, they're making 100 positive, and then 300 positive, and 300 positive, and a negative 50. Okay, so that's the cash flow. How will we do the discounting? Well, discounting is done. Again, you take the cash flow for that year, you take 1 plus R, you raise to n. If you do that, which means 1.1 raised to 1, you will get this number. So now we discounted this number to the present value. If I want to discount this number, I would take 300, and again 1 plus R, so it's 10%, and I will raise it to 2. And I'll get that number. That is discounted cash flow for 300. Discounted cash flow for this 300, even though these two are the same numbers, obviously when we're dividing by 1 plus R raised to 3 this time, this one is 2, obviously this is a bigger number, and hence you will expect that discounting will be more. So further away it is in time, less value it is for today. And that's why the discounted cash flow for 300 in year 3 is less than discounted cash flow for 300 in year 2. And then finally this number over here, and we did this. So, but then we add up all the discounted numbers, and we get when you add them up, you got positive 90.9, 247, 225, and minus 34. That's and that's called NPV. Okay. So the NPV process basically means if a company or investor is looking for some R, and let's say R in this case is 10%, okay, then we go through the analysis, we come through the cash flow, we calculate the discounted cash flow, we add them up, and we get the value NPV. If the number we add up comes out to be a positive number, then that means the project is acceptable. What that means is for that company that is expecting 10% return, and they get an NPV number that is positive, then the project is acceptable. Okay. Let's go back to the one that we did earlier, because that's the one I'm going to use this one and also do it again for the IRR, and then that's the one I'm going to also show you how to do it on Excel. So again, we went back. Remember the one we did, we had a project that was minus 100, plus 10, plus 60, and plus 80. And we did the discounting. In this one, I'm showing you the same information. I'm showing you vertically for just purpose of the room. So this is my 100, this is my 10, this is the 60, and this is the 80. So these are the numbers. If we discount it again, we got that number. If you recall from the other one, I discount this, I'll get that number. If I discount it, I get this number. If I discount it, I get this number. If I add them up, I'll get 18.79. So what does this mean? This means this project, for this cash flow that this project created, this project has a positive NPV. That means if the investor is looking for R of 10%, this project is acceptable. Now, how in a separate lecture, I will talk about the R. How does one come up with an R? I'll be giving you 10%, as the book says. Typically, typical projects, depending upon the risk and so on, we saw 10 to 20%. So we'll talk about the R in a separate lecture. Here, I'm just wanted to talk about is if we had picked the R, or if we're working for a company and somebody said this is the minimum return we want to make, how will we use NPV to figure out if the project is a go or not? We'll use that R, we figure out the discounted cash flow, we add them up. If the number is positive, then the project is a go. Now, what would happen if instead of R of 10, somebody says, this project is a little bit riskier, as the book talks about, riskier the project, higher the return they will want. Let's say somebody says, what, hey, listen, this project is a little bit riskier, we want at least 12%. So in that case, what we would do is we take each one of these things, and we say 1 plus R will be 1.12 raised to 0, 1.12 raised to 1, 1.12 raised to 2, 1.12 raised to 3. And obviously, in this case, we will get, these numbers will be smaller. These numbers will be smaller, and so obviously your NPV will be less, And so I'm going to make that point again in a separate slide. So if I go to the next slide, and first we want to talk about what is IRR, and then make the connection with the NPV. IRR is basically saying, if I have a cash flow of a project, be MaxInc, or in this case, the numbers we had, minus 100, 10, 60, and 80, and if I want to calculate R, instead of us starting with an R, if I want to calculate R, and R when my net present value will be 0. R when my net present value will be 0. So in this case, remember the other one, we had an R of 10%, and what did we have for net present value? We had like 18.78 something. But this one is, so that was for 10% R. But what if I want to know, hey, at what R will this number be 0? And so the way to do that would be by trial and error. Okay, so what do I mean by that? So remember, we did this one over here, and again, just to start from what we just had the conversation, we did this over here, and we said that for R equal to 10%, if I discount each one of these things by 10%, I get these numbers. If I'm add them up, a net present value is 18.79, and that was the R at 10%. Okay. If we continue to do this thing with different set of numbers, let's say we do it for 12, we do it for 14, we do it for 16, we do it for 18%, and so on. What you will do is, obviously, you'll expect that these numbers for a higher R, these numbers will get smaller and smaller, and hence this number will get smaller. And at some point, at some R, this number will be 0. Okay. So if I had done that and go through it, this is what you would get. You would get a 10%, when we do the calculation, we're discounting for 10%, we got NPV of 8.79. If I go to 12%, that's what I'll get. At 14, I'll get this. 16, 18, and about 18.1%, we'll get NPV equal to 0. So we are basically, by trial and error, calculating the R at which NPV is 0, and that R is called IRR. So IRR for this project is 18.1%. Okay, that's what it means. So